Hey everybody, it's Chris with Life 180, and I'm here in the Better Well Studios with the man, Dan Kaminsky.
Hey.
Kind of the wizard behind the curtain here for Better Wealth. He does all the policy design for all the clients that come through Better Wealth, and he really is uniquely talented. Is a geek and researches this stuff, and is kind of obsessed with it on a level that most people just can't even quite understand. And so. So it's actually interesting. I love his story. Just to kind of start with this is like, I remember when I first met Caleb, and Caleb called me from watching one of my YouTube videos and was like, man, I'd love to work with you somehow. And they came down to Arizona and visited, and Dan was like really quiet and didn't, he's just an engineer, guys. Like, and so like, this is a perfect role for him because he was a real skeptic initially.
That's right.
Like, he knew Caleb from a different, area of life. And like Caleb was talking to him about it. And when tell the story if you could, like when the lights came on for you on this stuff.
Yeah. So it was actually, I wanted to get into real estate investing.
Mm-hmm.
And the really the long story short is I wanted to start building passive income, wanted to get into real estate. And I knew that Caleb worked at the bank at the time. And I just asked him after a night of Frisbee. Actually, we played Ultimate Frisbee together. And I said, hey, well, you could introduce me to your commercial loan officer. He said yes. And I think the next day or something like that, I went over to his office. Okay. And instead of doing what I asked, he closed the door behind me and was like, hey, I want to show you something. And so what he does is he goes up on a whiteboard. If you see our house, we have
whiteboard central.
Whiteboards everywhere.
I got too many kids. It'd just be whiteboard scribble all over the place.
And he started teaching me the strategy of using life insurance and leveraging it.
Yeah.
Because I was looking at getting $100,000 investment property, and I was going to do the typical 20% down, that whole deal.
Mm-hmm.
I thought I knew everything that I knew or there was to know about money. And so he's showing me the strategy, and I absolutely hated it.
I love it.
It went against everything I thought to be true about money. Yeah, I was brought up in a pay cash for everything. Debt is bad.
Yep.
Put all your money in tax deferred accounts because you'll be in a lesser tax bracket when you retire.
Mm-hmm.
And what he was showing me is that if I took the same, a little bit more, but almost the same amount of money that I was going to put on the down payment on the house, put that into a life insurance policy, and then leverage the cash out of that to go get the down payment, my rate of return, it was going to be a 15% cash on cash return on that property. But my rate of return on those leveraged dollars was over 140%.
Mm-hmm.
And it blew my mind. I'm like, these are, everybody talks about, the stock market can do 7, 8, 9, 10, 12,
yeah, sure.
Pick a number percent. We're talking multitude bigger.
You could just buy GameStop and that solves everything.
Well, that too. But
that is not financial advice, by the
way. But I was looking at that and I'm like, if this sounds too good to be true, the age old, why haven't I heard of this before? And this sounds too good to be true.
Yeah.
But my inquisitive nature was like, okay, I got to figure out what's going on here, because what he's showing me is I could just go get an investment property with no money out of pocket because I'm not using my dollars to do it, because I'm leveraging the dollars out of the life insurance policy. Mm-hmm. And now suddenly my rate of return on those dollars is drastically larger.
Yep.
So I went out, started reading books, reaching out to people, met with Caleb like 6 more times. We used a calculator system called Truth Concepts.
Yep.
And he poured over the math for me. I had to see like frontwards, backwards,
You're an
sideways.
engineer. I get it.
And I went from the biggest skeptic to the biggest believer in like a matter of a week or two.
Right.
And was like, oh my goodness, this is true, and people need to know about this.
Yeah.
And so that's where, at that time when Caleb showed me the illustration software, I was like, I had no idea what a paid up addition was. I had no idea what a term rider was. I had no idea. Nothing. Absolutely nothing.
Yeah.
It was like the classic. I went back home and I told my dad, hey, I'm going to put like 30% of my take home pay into life insurance.
And he about died.
Yeah. Can you imagine that conversation?
Yes, I can. My father-in-law's a stockbroker.
So that really led me down the path of, okay, I really want to understand this stuff.
Yeah.
Because it's so clear that in the industry, very few people actually understand how these illustrations work, how these companies work,
totally,
how the minutia of it all. And, if you watch the previous video, we're talking about a 90-10 split. So a 10% base, 90% paid up additions, which in theory, people take that at face value, and they're basically saying, hey, I have 90% cash.
Right.
And 10% insurance cost, quote unquote.
And they want to say that's the only way to go.
That's the only way to go because you're maximizing cash, and it always depends.
Right.
It always depends. Like the part of the things that I'm interested in doing analysis on is a lot of times, because we're doing a 90-10 split, we have to really increase the term rider. to support the paid up additions. And my question is, in a reduced interest rate environment, as the dividends continue to fall, there is potential that you might have to, it could almost perform like an IUL if you have too much of a term rider on.
Okay.
And the dividend continues to decrease. And so that's why I always caution people of like, not everything is created equal. Not all 90/10s are created equal. Not all illustrations are created equal. Yeah. It's really important that you work with somebody that knows what's going on, because things change all the time. Like I said in the last video, we do an analysis every single year to see what the policies look like, what the companies are looking like, the different products that are coming out, all that kind of stuff to make sure that we're doing the right thing.
That's awesome. I love it. So what are we going to do here? Are we going to go through a different type of policy layout design?
Yeah. So we're going to do
all right.
We're going to do
Let's take a peek.
70-30 split this time.
All right. We'll give people some insight as to what the options are, because I know this policy tends to make a lot of sense for a lot of people. And so what I'd love is for you to run through it, break it down, and then talk about who you think it would work for better in some situations. And once again, before he gets into that, I want to make the caveat here. If you're watching this and you're like, oh my gosh, that's what I want, like that's what I need, you may not be able to get this. Like you may be able to, but there's so many variables at play here: your health rating, the amount of cash that you have to put into it, your age, like how long you want to pay on it for, like, you know, there's how much flexibility you need, like when you want to put the money in it, like there's just there's so many variables, right? So you need to take all that into consideration. And so Dan's going to go through kind of from a generic perspective, like who this would work for, and break it down. But just understand that you gotta talk to somebody and that knows what they're doing, and like really figure out what it would look like for you.
Absolutely. And one of my favorite things is when I call them armchair life insurance salesmen that call in and they're like, I watched all these videos on YouTube. This is what I want. And they're trying to tell me that this is how this stuff works. And I'm like, excuse me, you know,
they can throw a football 80 yards too.
Yeah. And it's like, I literally do this stuff every single day, 12 hours a day.
It's true. Every time I come up here, you're in your office and like you just work.
I think I know a thing or two about these. Yeah. So, I say that humbly.
I agree with you though.
But here's one of the things is, you know, we're looking same thing. This is almost the exact same policy as the one we looked at in the last video, except that the base premium is higher. So what we're seeing is a $6,000 base premium
instead of two.
Same $50,000 lump sum. So we're doing a total premium in the first year of $50,000
and $14,000 of PUAs.
That's correct. So instead of $18,000 of paid up additions, we're looking at $14,000 for a total of a $20,000 annual premium. Okay. So first thing you'll notice is cash value is about
$3,000 less.
Yeah, $3,000 less. Death benefit's almost exactly the same.
Weirdly.
Yeah. So it's, again, not, I could create an illustration like this at a different company. Everything would look completely differently.
Correct.
You know, and so even at the same company, I could design a different product and it would look differently. So again, this is truly, the funny thing is it's called an illustration, right? Like we're just illustrating something.
Yep.
And the same is true if I did a different product, if I did a different company. And that's something that I really want people to understand is we're looking right here, we're looking at projecting out 32 years. That's why this is called an illustration, because if you look back and actually do a historical, you know, look back on life insurance, if I gave you an illustration 40 years ago, the number, the cash value and the death benefit and the dividend at year 40, which would be technically this year, is not going to be anything like what it said before.
No.
And that's why it's so important to what we touched on in the last video is, what are we trying to accomplish in the first place? Because if we're just trying to look at it from the numbers perspective and we're not thinking about it in a greater context, there's a lot of things that can be missed in translation. And so for this particular policy, you know, a lot of people are going to look at this and say, okay, what's happening in year 8? Why is the number going from 20,000 to 19,561? And the reason for that is we're dropping off the term rider. And so what you'll see as well here is that the death benefit will drop off about $1 million.
Okay.
And we're doing that from an efficiency standpoint, because the term rider is technically a cost. And so the sooner we can pull that cost off, the policy is going to continue to be more efficient. Now, what's interesting is if we look back at the other policy, this death benefit continues to grow for quite a bit of time.
Because it's a 20-year term rider on the other one.
Correct.
Yeah.
And part of, it's a kind of a double-edged sword. If this is technically on a 35-year-old, and let's just say, unfortunately, this gentleman dies at year 15.
Yeah, 49 years
at 49
old.
years old. Mm-hmm. In the 90-10 scenario, there would be more death benefit.
Because you did its 20-year term, right?
Correct. However, if this is entrepreneur Life 180 member and is killing it in business and he wants to start another policy, it may not be to his benefit to have a lot more death benefit because it would prevent him from doing prevent him from doing another policy.
Right.
So that's why in this design, this could potentially be beneficial.
Let me explain that a little deeper.
Yeah, absolutely.
Because in the other one, it was like what, 2.7 million?
I think it was close to 3 million. Yeah.
Something like that in death benefit. So it's important to understand that you cannot be worth more dead than alive, essentially. Like they don't want to put you in a situation, no matter what you're looking to accomplish as far as living benefits go, it is still life insurance. So the risk for the life insurance company, they don't want you to have $10 million of life insurance if you only make 100 grand a year, 200 grand a year, right? Like you got to be really careful with that. And so if you did the other policy, the 90-10, you did the 20-year rider, you have $3 million of life insurance. Well, if you happen to be in a financial position where you only qualify for so much insurance, so maybe you only qualify for 3 million life insurance, right? Like, and if you're at 2.9 million and now you go, wow, I want to jam more cash on one of these things, you're not able to,
right?
You're not, like, you completely handicap yourself. And like the important thing to understand that, like, when you handicap yourself, you can't convert that convertible to, or that term in the rider for the other policy in the 90-10 without creating a MEC.
Correct.
And that creates a whole different set of problems.
That's right.
So, and you don't want that, like, especially, you just don't want that. And so this is a way, like, if you think it ultimately doing it this way, even though it may not be quite as efficient at the beginning,
right,
it allows you over a longer period of time, if you want to get more money into it, it gives you that flexibility.
Yeah.
Not this policy necessarily, but it would let you, like, either like what I would call stack another policy on top of it.
Right. So, and that's the thing I really want to be clear on is, like, we're looking at a 70-30 design here, and we were looking at a 90-10 in the last example. And people look at this and say, it's easy to compare the two, and it's not even close. These are apples and oranges. The numbers almost look the same.
Yep.
But it's completely apples and oranges depending on your situation.
And I would argue if you really have the life insurance need, the 90-10 can be a great thing.
Totally.
If you don't really have, if you're not buying this for the life insurance and you're willing to sacrifice literally a couple grand of liquidity on the front end of it, and you want the ability and the flexibility to potentially do more, especially think about the fact that, like, maybe 15 years from now, you're going to sell your business and you want somewhere to be able to jam that cash or, like, do something with it. Like, and you want the ability to do that, this is potentially a better option.
Absolutely. And the other piece here is we're looking at, instead of $2,000 a year, $6,000 a year of this gives you the opportunity to pay more money in long term, which, again, in that idea of we're giving up a little liquidity early on, but this policy,
but look at it grow.
Yeah, this policy will grow better long term.
Way better.
And again, if we look at these apples to apples, we're going to see that there's obviously more money going into this policy because you're paying more, but that can be a great benefit. This goes back to if you watch the first video and I said, hey, if I had a bank account where you gave me $6,000 and I give you 51.5 back, when do you ever want to stop paying me? If we went further down and started looking out to age 70, age 80, age 90, and we again remember that compound interest is three things: volume of money, interest rate, and time. Well, what we're doing here is we're increasing that volume of money.
Yeah.
And when we start looking 40 years down the road here, regardless of what happens with interest rates and all those things, compound interest is going to start kicking in big time.
Sure.
And when you have more money, amazing things start happening.
Well, and just to reiterate, like, this is also the great part about this is it's just leverage, right? Like, I mean, this can be used for whatever you want. You can use it for tax-free income. And I would argue, like, you could use this if you get 30 years down the road and dividend rates are horrible. And I mean, because that's the projected, the guaranteed side isn't quite as good, obviously.
Right.
But, like, so let's go worst case scenario. You're having to deal with the guarantees here. And at 65, you got $734,000. You're still, like, you have access to that money, and you can use that money for real estate. You can use that money. And if you need to do something of that nature, you can use the real estate to create the cash flow and
Absolutely.
supplement, which will, it just gives flexibility. And
Well, and that's why we call this an and asset a lot of times,
correct.
because it can enhance so many other things. It can act as
Yeah.
a volatility buffer
Totally.
if you're drawing from market assets. It can operate as basically tax-free income. It can operate as an investment tool. It can operate in a lot of different fashions. We've barely, I mean, we touched a bit about the death benefit, but we're not even, when we talk about life insurance,
Yeah.
the death benefit is basically the icing on the
Totally.
cake.
Yeah. Yeah. I mean, it really is. And listen, life insurance is important. I'm a big believer in it. But I'm also a believer you buy this policy for the cash accumulation. And if you need to supplement this with a term,
Yeah, absolutely.
convertible term policy, do that.
Totally.
You know,
I'm a big believer in human life value, and that's basically a calculation of your current age, income, and net worth.
mm-hmm.
And for this gentleman at 35 years old, let's say he's making $100,000, he's got quite a bit of quote unquote work life and human life value. And at 1.7 million, he still has room probably up to about that 3 million mark, depending on what kind of assets he has and things like that.
Sure.
And my take is that we should always go for approved death benefit. So if this gentleman got approved for 3 or 3.5 million, I would always suggest to, in this design, we're going to only use 1.71. So I would always suggest to at least get the difference. So let's say it was 3.5, you would get the remaining in term insurance so that you have the ability to start another policy in the future and lock in your health rating essentially.
That's the big thing, because I'm 30, I'm 40. I just turned 40. Oh my gosh. And it's like you lock it in simply because a lot of things happen in your 40s, and like I have my best friend last year died at 51, totally out of the blue because of a heart infection, because of a tooth infection. It was crazy. And so like, you never know with these things. And, I think having that flexibility, building that strategy and listen, there's a reason the life insurance company caps how much you're allowed to have.
That's right.
So if they're capping it for a reason, because they don't want the exposure. So if I'm you, if I'm taking it up to the max that I can get for the insurance component, because there's a reason they do it.
Right.
So same thing with, well, I'm not going to get into the government and taxes and all that stuff. That's too long of a video. So if you have any questions about this, we did a video. If you haven't watched it already, if you just happen to kind of stumble on this one first, go check out the 90-10 illustration, and really, watch both of these videos, go back and forth, check out which one kind of works best for you. If you have any questions about it, once you go through them, reach out to these guys. They're awesome. That's the thing I love about them. They're very process driven, very objectives driven. They're not going to push people into products. And if anything, they're going to push you away from the product until you're not ready for it yet.
Yeah.
Which is one of the reasons I'm up here filming with them and trying to create content to serve entrepreneurs and do what we're doing. So that's it. If you have any comments, click below. Go ahead and click the subscribe button. If you found value in this, make sure you hit the bell that we get notified every single time we put out a new video. And I guess until next time, have a blessed, inspirational day. And we'll talk to you soon. Take care.